Happy Monday, everybody. Today is December 29th, 2025, and this is your Monday market update. And yes, the final video of the year. This is one of those weeks where markets slow down, calendars thin out, and volumes drop, but that doesn't mean nothing is happening. Year-end weeks often reveal how investors are really positioned. So let's get back to the markets. Let's walk through last week day by day, and then we'll zoom out. Markets opened the holiday shortened week with a quietly constructive tone. There was no single headline driving trade. Monday was about positioning. After a choppy first half of December, investors leaned back into the large cap technology and AI linked names, signaling renewed confidence heading into year end. What stood out wasn't volume, it was intent. Capital moved towards leadership rather than defensive, suggesting investors were comfortable carrying risk through the calendar turn. Breadth improved modestly and cyclical groups held firm. The Dow was up just under 0.5%, S&P up about 0.2%, and the Nasdaq was up just over 0.5%. Tuesday brought confirmation and another record. S&P 500 closed at fresh all-time highs as investors digested stronger than expected economic growth data and continued to look past near-term rate uncertainty. What mattered was the reaction. Instead of good news is bad news, the sell-off, stocks pushed higher. Leadership broadened beyond mega cap tech, with industrials and select financials participating, a healthy signal headed into 2026. The Dow was up less than 0.25%, S&P up just under 0.5%, and the Nasdaq was up just a little bit more than 0.5%. Wednesday was, of course, Christmas Eve and an early close, shortened session, but not an unimportant one. With markets closing early, volume was extremely light, yet stocks continued to drift higher. Both the S&P 500 and the Dow finished at new record highs. This wasn't speculative chasing, it was steady accumulation, particularly in industrials, financials, and infrastructure-linked names. More about not being underinvested than trying to squeeze out upside. The Dow was up 0.2%, S&P up just over 1/3%, and the Nasdaq was up just over 1/4%. Of course, markets were closed for Christmas Day. Friday delivered exactly what you'd expect after a strong holiday week, a pause, not a reversal. Very little news, very little volume, some modest profit taking, but no rush for the exits, no spike in volatility, and no defensive rotation. Just digestion near record levels. The Dow was down a fraction of 1%, S&P 500 essentially flat, and the Nasdaq was down less than 0.1%. For the week, the markets continue to do what they've increasingly done in the second half of the year, absorb uncertainty and keep moving higher. The S&P 500 was up about at 1.5%, with both the Dow and the Nasdaq also higher by more than 1% on the week. Professional money managers are largely fully invested. Cash levels are low, not because of euphoria, but because staying underinvested into rising markets creates career risk for them. Retail investors remain more cautious. Cash balances are still elevated, even as markets make new highs. Many investors don't want to be reckless, which raises an important question. What actually defines reckless? In my opinion, markets spend a lot of time at new highs. That's how compounding works. If buying at highs were reckless, long-term investing wouldn't work. And we know that historically it does. Buying at highs can make sense when earnings are growing, liquidity is supportive, and trend is intact, and you have a plan. Buying at highs doesn't usually make sense when you're chasing momentum with no strategy, concentrated in one trade, using leverage, or investing short-term money. Buying without a plan is reckless. Buying at highs with discipline often isn't. As a reminder, this ties directly into what we discussed in Friday's planning video. Year-end isn't about predictions, it's about preparation. Simplifying what's cluttered, strengthening what matters most, and choosing one meaningful stretch heading into the new year. Markets will do what they always do in January. They will test your confidence, create noise, and tempt reaction. Planning is what keeps that noise from turning into decisions you later regret. Looking ahead, the macro conversation is shifting. There's growing discussion about GDP reaccelerating towards 4 to 5% in the coming year. Not all growth is created equal. Demand-driven growth risks overheating. Supply side growth, productivity, AI, automation, capital investment is far less inflationary. Same GDP number, very different implications for rates and markets. The economy is growing at 4% or better. Aggressive rate cuts wouldn't be normalization. They'd be unnecessary. Markets are starting to wrestle with that tension. A few quiet signals to keep in mind. Initial jobless claims remain low at 214,000, pointing to cooling, not cracking in the labor market. And also dividends do continue to matter. Over the past decade, dividends accounted for nearly a quarter of the total S&P 500 returns, cushioning sideways periods and compounding quietly over time. Let's talk about the week ahead. Another holiday shortened week. Markets are closed on Thursday for New Year's Day. We'll see pending home sales. We'll get the Fed meeting minutes, and we'll get weekly jobless claims. Bond markets close early on New Year's Eve. Stocks trade a full session on New Year's Eve. With no major earnings, positioning and sentiment, not headline, are likely to drive price action. As we close out 2025, the takeaway is simple. This year offered plenty of reasons to stay cautious, and discipline worked again. Markets climbed a wall of worry. They usually do. As we head into 2026, the fears will rotate and the narratives will reset. The principles won't. Have a plan, stick to it, and don't confuse patience with passivity. Thank you for trusting me with your time each week this year. I look forward to continuing the conversation in 2026. Have a great week and a happy and safe new year.